Welcome to Finance in Excel video number 99. Hey, if you want to download this workbook for Chapter 10, click on the link directly below the video and scroll all the way down to the Excel Finance class section. Hey, we got to talk about history here, USA capital market history. We're going to start over in our PowerPoints, which you can also download. Capital market history. Well, why do we look at the history? Oh, maybe it'll help us figure out what to do about the future. But in the stock market, looking at the past can perhaps provide some insight into the future. As we mentioned in just a couple videos ago, if you are looking at the past has certain patterns. If you use that past and those patterns to predict the future, and then something happens in the future that wasn't in the pattern from the past, then your model doesn't work very well. Nevertheless, people do it all the time because oftentimes that's the best we can do, right? All right, using past to predict future can be dangerous if the past isn't representative of what the future will bring, right? 2000 and 2007, people around the world looked at past house prices to predict future house prices. Now, what the people did here is they only looked at part of the past, right? They saw the house prices shooting up in 2004, 5, 6, 7, right? And so they just assumed it would go on forever. Right? And the other thing they weren't doing is they weren't looking at fundamentals. If they had done present value of future rents for houses and discounted them back, they could have seen that the prices were not accurate. Nevertheless, this is an example of people taking just part of history and which there was a pattern there, right? Prices were just skyrocketing up. And they took that and used it to predict the future. And it didn't work out so well. Same in 95 to 2000 with internet stocks. Nevertheless, it is very useful to look at history. There's a great study. These two guys here did a famous study with 5 financial instruments. And here is some of the visual evidence. Let me close this here. They looked at, I can't get this much bigger. Oh, I can close this. Here is small company stocks, large company stocks. These were long-term government bonds. This one right here was Treasury Bills, and this was inflation, right? So you can clearly see, even though these top ones are incredibly volatile, and we talked about that in the last video, incredibly volatile, over the long haul, they had significantly more return. So $1 invested in 1926 grew to be in 2008 $9,000. For a large company, it grew to be $2,000. Government bonds, $99. And Treasury bills. Notice how smooth and predictable this is. And Treasury bills for us, we mentioned this once already, but Treasury bills are considered the risk-free rate. So whatever rate Treasury bills are earning is considered the risk-free rate. Not only can you see that there is not very much variation, but the thinking goes, well, if a Treasury bill, which is a government issuing debt, and it's very short term, maybe a month or something, probably within a month, they're not going to default. And not only that, but if the government got in trouble, they could raise taxes or they could to pay off. So it's considered the risk-free rate. And then there's inflation. All right, let's go look at our next slide here. We want to learn 2 things about the financial markets. And our first picture here, we can just see there's a huge difference in the return. Now let's think about, and we can see volatility here too. Let's go look at individuals. This is the large company. So some years it's way down, some years it's way up, right? So this gives us a picture of the volatility. This is actually called a column chart here, and it just shows you each return for each year. Let's go look at, this is large company. Let's go look at the next one. Government bonds. Okay, so you could see it looks a little bit less volatile, right? The reds aren't as big, but the on average, doesn't look like the ups are that big either. Let's go and look at our next one, Treasury bills. Oh, there's no red, right? This is the Treasury bill. All right, so we see a little bit of volatility there. I'm going to jump way ahead. I'm going to have to jump way ahead here. In our last video, we saw how to actually calculate a measure called standard deviation for volatility. But what we're looking at here is a chart of this. This is the information from the authors. They have a huge table. And actually, in our Excel workbook on the data sheet, I tried to transcribe it all here. But this is from 1926 to 2008. These are all the returns, the holding period returns, right? And then you can calculate some averages. But let's look here. Here's the average for our historical large company returns, right? So you can see very spread out. So obviously the deviations and this for any particular year, you could lose a whopping amount or gain a whopping amount compared to the average. When you get down to our government bonds, right, much less volatility. There's the average. There's all the data points. So for still on any year, you could lose some money and gain some, but the spread isn't quite as big. And here's the Treasury bill, right? And then you can see it's just all crammed right in there. So when we calculate standard deviation, our measure for risk of the investment, this is going to be very small. Here's another way to look at our history. This is for large company stocks. This is called a histogram. We grouped. So for 20 to 30%, 13 years earned from 20 to 30%. 10 to 20, 16 years. Now, actually, this is a histogram. The last one was a XY scatter with some tricks, and then these were columns. We're not going to learn how to do those in this class. In my stats class, we learn how to do all of those charts. But the point here is we're using these visual aids to see the distributions and what the data looks like. Are there any patterns, right? Here we can clearly see the pattern is volatile, very volatile, less volatile, not very volatile. We can see returns are never look like we're never getting nominal returns are never negative. We see some volatility. We see some more volatility. So we're noticing some patterns in our history. All right. One more thing before we go over to Excel and make some calculations based on our historical data. Do you kind of notice there's a slight shape to this? And anytime you look at past data and observe a slight bell shape, there's a very nice statistical tool we can use called the normal standard curve. Now, in this class, we don't get to talk a lot about it. Let's see if I can scroll ahead. These are the PowerPoints. And there it is. There's the normal standard curve or standard normal curve. And what's nice about this is that it's completely described by its mean and standard deviation. And what that means is right here, we're exactly at the mean. So the deviation from the mean is 0. And the return is 11.7%. But because it's a regular shape, a bell shape, there's some probabilities. And probability is all the area under the curve. Well, between one standard deviation, remember, last video we calculated standard deviation. Well, if you take the actual mean from the data and the standard deviation, you can say, I can give you the values for the low end and for the high end that'll tell me 68% of the time where most of our returns will lie. And so you take 11.17 and you subtract one standard deviation and you get minus 8.9. And then you add one standard deviation and you get 32. So remember, and we'll do this in just a moment. We'll actually calculate this. But the concept is this. If it's standard normal, you can then just do this calculation. You say, 68% of the time I'm going to expect to get minus 8.9% up to 32%. Now, the big caveat with standard normal is since it's so easy, lots of people cram data that is not bell-shaped, and they try to use this model During our financial crisis, one of the famous quotes from the investment banks, and I can't remember which one it is now, was, "I'm seeing a minus 20 or a 25 standard deviation event," which means they had something happen which was not minus 1 standard deviation or 2 or 3, but 25, and that's not possible. That's just not possible. And it meant that their model was wrong. And so oftentimes in finance, people cram, or not just finance, all endeavors, they cram their data into a bell-shaped curve when they should not. Now, for us in finance, let's just look. Here's a little mini column chart for large company, small, long-term corporate debt, long-term government debt, intermediate U.S. Treasuries, and inflation. Well, you could see, maybe it's slightly bell. I don't know about this one. There's some bigger ones in the middle, but this looks kind of like cramming data into a bell-shaped curve. But guess what? People do it. So all of these maybe are slightly. They're not, especially this one. This was the least bell-shaped. And you would expect that, right? Because these are small company stocks. Large company stocks, the idea is they're probably pretty large and stable. Right? These ones are startups. Some of them are going to crash. Some of them are going to burn. Maybe they have some really bad years and good years before they become large and stable. All right, so last video we saw how to calculate standard deviation. Here we're just given the average returns are 12.3 for large company stocks from historical data, and the standard deviation is 20. The small is 17. The large, the standard deviation, the risk is 32. Corporate, 6.2, 8.5. So all the way down. So Treasury Bills, 3.8 with a standard deviation of 3.1. All right, so let's go over to Excel. And I know if you've never done any statistics before, it's kind of rough just to have the standard normal curve thrown at you. But let's see if we can look at our historical data, make a couple of calculations, and illustrate to ourselves these two lessons we want to learn from history. Now, I have R sub H, that means return from history, and R sub F, that means risk-free. Where oftentimes and in common practice, people take the U.S. Treasury bill as the risk-free rate. And so what we want to see is, if this is the risk-free rate, why are these other returns, some of them are bigger and some of them are smaller? So let's just see what happens. I'm going to take large stock historical average minus what's assumed to be the risk-free, and lock that one. Control Enter, and I'm going to copy this down. What this shows is that there is some reward for risk, right? And we saw, if I could quickly get to that chart right there, you could see that there's some big volatility, right? So from any given year, you could lose dramatically or gain dramatically, right? So there seems to be more risk in the small stock here, right? And so look at this. Somehow, if we take out the estimate for risk-free, it looks like there's a premium, an extra reward for the fact that the small stock is the most risky. The next riskiest one, just judging from our visuals we had, right, that the large stock seems to be making 7.9. And as each one of these corporate and then government, which is a little bit less volatile than corporate bonds, for each one, the amount of extra return or reward for risk goes down to when, of course, here it's 0 because we're subtracting this from this. So capital markets history lesson number 1. History tells us that there's a reward. Excess return over risk-free premium for bearing risk. Risky assets, on average, earn a risk premium. Now let's go look at standard deviation. Now actually I should make this screen a little bit smaller. Here we calculated our reward for risk. And down here, same exact historical averages, but we also calculated the standard deviation. And now you could see, if I say equals this, copy it down, you can clearly see that the biggest, this is our measure, numerical measure for standard deviation for risk. Clearly, the biggest risk, the highest return. Here, the second biggest risk, the next highest return. Over here, we have, oh, look at this. The government bonds turn out to be a little bit, standard deviation a little bit bigger than this one. Oh, and we only got 2.3. This one's a little bit smaller and got 2.4. Actually, if you do division, you could figure out the amount of return per 1 unit of risk. And obviously, this would be pretty good compared to this. OK, so lesson number 2. History tells us that the greater the potential reward, the greater the risk. Let's see. More reward, more risk. More reward, more risk, except for that little difference here. In general, that is true. And I'm sure you've all heard this in many other business classes. There is a reward for risk. So history tells us the greater potential reward, the greater the risk. For any given year, there's a significant risk of dramatic change in value, though, right? So lesson number 1, we get a reward for bearing risk. Lesson number 2, the higher the risk, the more the return. Now, we want to think about the standard normal curve. And I'm actually going to blow this back up here. Our standard normal curve. If I come over here. All right, so what this says is we can go down 1 standard deviation and up if it fits into a bell-shaped curve and get a range of values. Not only that, but we can do a range of values for 95. If we go down 2 standard deviations and up 2 standard deviations, we can have our 2 lower and upper values and say 95% of the time returns will occur between these 2 values. So let's go ahead and try and calculate that here. Now, equals, for the lower, I'm going to say the average minus the standard deviation. And I can drag this down. So there's our, that's how we calculated that over in that chart. We said that minus this. So we're talking about upper and lower and 68%. But you can also say between 0 and minus 8.9, what's half of 68, right? So 34. So if we were to say the probability of getting a return between minus 9 and almost 12 is 34%. Now let's do the upper. Same exact thing, except for we add it. Remember, this was a measure of deviation, right? How far it is away at any particular time. And this is the average. We added up all the deviations and divided by the count. And in essence, that's what we did. So this is an average deviation, right? So we're adding this amount on the up end. And so we get that. And we can double click and send this down. And so for small stocks, you can see 68% of the time we're going to get a return between almost minus 17 and almost 50%. Right? It's a huge spread. And that makes perfect sense, because what does standard deviation measure? The variation or the spread in the data. So those are our ranges for from historical data. Now let's go ahead and calculate 95%. Oh, that's 2 standard deviations. So I'm going to go minus this times 2. Ooh, negative 30% almost. And this one's going to be on the upper end. Hey, our return plus our average deviation times 2. So we're double click and send it down. So now we can say 95% of the time, which is a lot of the time, we're going to get a return between minus 30 and 52 based on our historical data, which is from 1926 to 2008. All right, that's just a little look at, oh, I do want to calculate the real, and actually this is wrong. As we saw just a few videos ago, and remember from chapter 6, our real rate can be calculated. 1 plus big R is nominal divided by our 1 plus and our estimation for inflation. That's the formula we're going to use, so let's go ahead and do it. Oh, there's our nominal return divided by 1 plus our nominal return divided by 1 plus, oh, and here's our estimation historically for inflation, an average over all those periods. And I'm going to hit the F4 key. And then we got to subtract 1. So this was the change in purchasing power. All right, that's a little bit about 1926 to 2008, and gained a couple insights. Risk, if we are taking on a risky investment, we're going to get some excess reward. And secondarily, if the more the risk there is measured by standard deviation, it looks like the more return we're going to get. All right, we'll see you next video.